Well, we finally got it. We got the big headline news that inflation came in last month at 8.3%. That was the result. Now, whether that was good or bad, it's a little bit up for debate. It was kind of mixed. It's not the best report. It certainly could have been better, but it also could have been worse. I went to bed last night just hoping that inflation would not be 9% or above. And not just because of my portfolio. I mean, every tech portfolio is taking a beating right now, but more so just because of the general economy. Inflation is terrible for almost every part of the economy. The Fed needs to get this under control. So there's good and bad in this report. The 8.3% reading was lower than last month. That's the good news. It was actually a lower number in the first 8 months than the previous month. So it actually declined a little bit. That's the positive glass half full look at it. The bad news is that it was above expectations, and there's reason to believe that it will actually go back higher. So let's go ahead and look at more of that bad news side of it. We have the Wall Street Journal here, and they highlight that inflation is still very high. 8.3% is incredibly high, and it shows signs that it's going to continue to face upwards pressure. So what is that? What are those signs there? They say in this that the Labor Department's Consumer Price Index last month marked the 8.5% annual rate. Again, less than last month, but above expectations. They say, but the decline came primarily from a slight easing in April gasoline prices. So what helped out with this last report is that in April, gas prices actually declined a little bit. That actually relieved a lot of the inflation. But if you've been to the gas pump recently, anytime this month, gas prices are back to all-time highs. I filled up one of my vehicles and it was $70 at Costco. It was like $4.50. The highest I think I've ever paid in my life for gas. So gas prices are right back up to all-time highs. And going into next month, that means that this month we might see, again, record high inflation. That's the big concern. There's also more concerning parts of this. They say that prices rose for groceries, dining out, air travel, and other services. So no longer is it just buying houses or buying cars that are, used cars that are going up 40%. Now it's bled out to all the services. Inflation has now taken place in services, which is more difficult to supply, more difficult to get rid of. We have grocery stores charging way more. Whenever I get groceries for my family, I'm paying way more than I used to. We have dining out costing a lot more. I look at different restaurants. I own a couple different restaurant stocks. I own Starbucks and Domino's and Texas Roadhouse. And I recently just read Texas Roadhouse's earnings report, and they raised prices by 3%. So it wasn't a massive raise in prices, and they're a very value-oriented company, so they're trying to keep prices low, but they have to deal with inflation as everyone else. Beef prices have gone up. Texas Roadhouse has to raise prices a little bit, and most other restaurants are raising prices even more. They say that restaurant dining prices rose 0.9%, the most since October. That is in 1 month's time, almost a full percentage. Here's the most concerning part of this report, though. They say that inflation is no longer just contained to the supply chain. So all the talk of the big thing causing inflation is the lack of supply, right? China and the logistics and getting supplies to the US. That's not it anymore. Now it's ingrained in lots of different parts of the economy. That is the big concern here. Now, they also mentioned that the Fed will have to work much harder to get us back to 2% inflation. And obviously that's true. We are so far from that 2% target. Being at 8.3% is a slight improvement month over month. I think the Fed will look at that positively, but also the Fed wants to raise interest rates without throwing us into a recession. That's what they're trying to do. So solving inflation is not their only objective. They also don't want to throw us into a bad recession. And if I had to guess, the Fed being this far away and the rates that they might choose to raise it next time, my guess would be another 0.5%, another 50 basis point raise. They could up it to 75 basis points. I don't see them doing 100 basis points in a full percentage. If I had to guess, it would be another 0.5% raise. Now, another interesting point they mention here is that consumers don't seem to be feeling the pressure in the squeeze of higher costs. For example, they say, quote, "We're still at a point where consumers and business resistance to higher prices is severely reduced because no one has confidence that if they wait, they'll find better prices that they want in the future." So that does give businesses more pricing power, but that's probably a temporary phenomenon. Now, that's the way of saying that right now consumers are paying up, they're ponying up the cash, they're going and doing what they want to do. They're paying higher prices for groceries because they need that. They're paying higher prices for gas because they need that. They're also going on vacation, paying 20, 30% more for air travel. That's not something that they necessarily need, but they're doing it anyway. And consumers have a lot of ability to spend right now, but I agree with this in that I think it's going to be a temporary phenomenon. I think this will be short-lived. I've already seen a lot of, I think, semi-concerning reports. We have Amazon saying that they overstaffed in their warehouses. They no longer are on a hiring spree trying to hire everyone they can for their warehouse jobs. We have Facebook putting on kind of a temporary hiring freeze for their developers. So even high-end jobs are saying, slow down on the hiring. We don't need to hire as many people. We have Netflix saying the same thing. They're doing a hiring freeze. And in fact, they're actually cutting costs and they're firing some of their employees. So we have a lot of the big tech companies doing the exact opposite of the big hiring spree that they did over the last year. And then on top of those big tech companies, I also have a number of contacts in different tech companies all around me. I know a lot of people in this field, and many of them have mentioned the same thing. They recently, at least previously, had big aggressive goals to expand their employee count, right? To hire thousands of people. And many of them have kind of brought in that goal a little bit. They're not hiring quite as many people as before. In general, I think companies are starting to get the hint that things might move a little bit slower in the future, and they're tightening their budgets a bit. And I think that consumers will be the last ones to get this. Right now, consumers are spending like crazy. They're going to Disneyland, they're going on vacations, they're spending tons on gas and grocery and eating out at restaurants. Texas Roadhouse recently said that they saw no slowdown in demand, even after raising the prices 4%. So consumers are out there spending left and right. They haven't gotten the hint yet, and I think they're going to be the last ones to get it. I realize that consumers had a big amount of money given to them through the capitalization that happened through the stimulus. So this big spike in savings rate by U.S. households, this wasn't because they budgeted well and saved money. That's because they were given stimulus checks. And then the second and third spike were additional stimulus measures. Enhanced unemployment stimulus checks. This is what spurred a lot of that inflation. But as you can see, without additional capital being given to consumers, their savings rate goes down. We're not good at saving money in the US. Most people spend every dime they have. And eventually, the amount of money that they got from the pandemic efforts to keep us out of recession, that is eventually going to work its way out of consumers' hands. When that happens, which I don't know when it's going to happen, but I assume sometime soon, I think that we're going to see consumers pull back on spending. So that's just my opinion. I look at this data and I see savings rates going down. I don't think consumers can continue with this level of spending forever, but who knows? Trying to predict this stuff is difficult. That's just my opinion. Now, in terms of what I'm doing with my portfolio, the story fund the answer is not much. I'm not doing much, and really, even though I look at all this economic data and I think it's interesting, in reality, I do bottom-up analysis, meaning I look at the companies and the fundamentals and the leadership and the balance sheets, the valuation, right, the PE ratio to price to sales. I look at that stuff, and then I kind of glance at the global economy, right? I don't do it the opposite direction. So that's my approach. I'm not a macro top-down investor. I'm a bottom-up investor. And these companies, from the ground up, I think are very solid fundamental companies that will continue to grow their free cash flow for a long period of time. I think that they're at reasonable valuations right now. Being reasonably valued does not mean that they can't fall further in price. I fully expect them to trade down in price. And I know it seems insane to hold companies that I think will trade down in price, but I am not confident in my ability to be able to time this bottom. Just not confident in it. So seeing as I don't know where the bottom is, or how many days we'll just see more 2-3% down days, I'm not going to try to time it. So I'm fully aware that I have no real ability to be able to time the market and time the bottom of this sell-off. I don't know when it's going to happen. I don't think most people do. But what I plan on doing, my strategy, knowing that we have massive negative momentum in this market and many headwinds, is to basically be patient. And I do have some additional cash I'll be deploying, but I'm going to be deploying that cash on a very incremental basis. So at the end of this month, I'll be doing more buys. I'm going to be doing some buys of probably Amazon and Facebook. So I'll look how things pan out between now and the end of the month. I'll assess what companies I think have fallen the most to the most attractive prices, and I'll simply pick up some more shares at what I think are attractive valuations. I know over the next couple of months, this is going to be difficult to look at and hang on to, but I realize that the market's not going to be falling for 6 consecutive weeks and 7 and 8 on indefinitely forever. At some point, the market does bottom. So that's a little look at the inflation report and my portfolio. We'll see you in the next one.